Welcome everybody to another lecture in our beginners course series. Tonight we're going to be discussing indicators and how they can be used to continue to build stronger theses when making trades based off of price action. And we're going to continue to develop this idea tonight as we have previously talked about, and I'll show you guys some of the classes that we've covered so far. This is kind of the main meat of the course series, kind of the candlesticks, indicators, patterns, and the sectors of the market section. But before this, we've also covered support and resistance, the basics of options, all that other good stuff. If you guys are looking for that reference, please feel free to go check out our playlist on YouTube. You can see that playlist. I have it posted here in the live classes tab. You can just check it out right here. You can click this link and you can see everything that we've been through so far. So tonight, again, like I said, we're going to continue the beginners course series tonight, and we're going to continue to build on the knowledge that we've been creating over the past, I think we've been going at this for 6 weeks now, 6 lectures, so maybe 5. So it's been really good so far. I think people have been enjoying it. And obviously I'm a little bit biased, but we'll see how you guys feel after tonight. So just to reiterate, the goal of this session and these lectures as a whole is to create successful traders who can find the highest probability trades and act on those opportunities with confidence. And the way that I am planning to help you guys all develop into these types of traders is give you a broad set of knowledge in order to develop your own strategy, to make your own decisions in the market, to where you don't need to rely on anybody else. And you have all the tools you need in your tool belt to be able to react to price action accordingly, to be able to understand what the market is doing all on your own. That is our ultimate goal here. We don't want you to have to be here a member for your whole life. We want you to get the knowledge that you need, become consistent, and obviously we'd love for you to stick around, but we know that it costs money to be here. And obviously that's not reasonable for everybody, but that's a side note. So just to reiterate, I've been in each and every one of your positions before, whether you have no idea what's going to happen tonight, or you have a little bit of knowledge or maybe a little bit more knowledge. I know exactly what it's like to know nothing or know a little bit or whatever it might be. So as always in my lectures, I do my best to cater to each and every learning style and each and every level of experience. So bear with me if maybe I explain something a little too quickly or too slowly or whatever it might be. That's just me trying to make sure I'm as accepting, if you want to call it that, as everybody. And I'm doing my best to use my experience here teaching to give everybody as good of an understanding as I can. In these lectures, I always start with relatively simpler content and continue to build on that content as we progress throughout this lecture. For the most part, the content in this lecture at the beginning is all relatively similar in difficulty. We're essentially going to talk about some indicators. We're going to talk about what they mean, where they're derived from, some rules to obey when using them, and some strategies that you can use with them. Towards the end of this lecture, I'm going to talk more about specific indicator strategies. So stick around if you want to see some more detailed information on making actual trades, how I use indicators together, not just one at a time. So stick around to the end if you want to hear more about that. But I think with that being said, we are ready to get right into it. One last thing that I want to note is just like candlesticks, just like patterns, just like support and resistance, there's no end all be all to technical analysis. There's no one way to look at a chart that's 100% right each and every time. No matter what you think or what anybody else says, there's never one thing that you can do each and every time you make a trade and it works, unfortunately, right? I know nobody ever wants to take losses, but that is the reality of trading, whether you like it or not, and you have to be able to manage that. So when we use different aspects of technical analysis in conjunction with each other, whether it's multiple different indicators, support and resistance, patterns, whatever it might be, right? Flow. All those things help build a probability for a trade in the market. And that's all trading in the market is building probabilities in your favor that allow you a higher chance of being correct, right? That's what we really want, is to be right. So just wanted to lay that out there, as I always like to at the beginning of these lectures. And with that being said, let's get right into it. So in the previous lecture, I talked about setting up indicator. Well, actually I didn't. That's in a more previous lecture. And then we spent all of last lecture talking about volume and price action. So if you want a really in-depth look into that, you guys can feel free to refer to that lecture. I'm not going to touch on it at all tonight, just because I spent an hour on it with Flips last time, and I think it was a really solid lecture. So if you want to hear more about volume, which is very important, that's why we spent a whole session on it, please refer to the previous lecture. With that being said, I'm going to get into the first class of indicators that I like to consider oscillators. And these indicators are some that go below the chart. They don't overlay the price action. And if you don't know what I mean when I say that, you guys will see in a little bit more detail what I'm referring to. So let's take a look at some different oscillators. First one, and one of the more common oscillators that I think people typically see is the MACD, or also known as the moving average convergence divergence. Essentially, the MACD is a relatively basic indicator that helps you determine momentum in the market. This is something that is relatively commonly used. It isn't something that I typically use on a day-to-day basis. However, it is something that I sometimes use to confirm trades. Essentially, when you're looking at the MACD, you're looking for a few different things, right? As the name suggests, moving average convergence divergence. You are looking for these moving averages that are depicted below on the chart to converge and diverge and see how they react with each other. That's kind of the basics. So one of the first things that you want to be looking for when analyzing the MACD is you want to look for crosses to the upside and downside for different signals. So you can see here, we have a cross to the upside, right? So this blue line, which is the 12 moving average or 12 exponential moving average, crosses above the 16 exponential moving average here. And that produces these bullish histogram bars below, or these green bars below. And essentially that means that momentum is to the upside. And for those of you who don't know the terms bullish and bearish, essentially bullish means I think a stock is going to go up, or bearish means I think a stock is going to go down. So bull is like green, bearish is red. So here you can see we get this bullish cross to the upside, which is also denoted by these green bars on the histogram, which helps make it a little bit easier to see. There's some different versions of the indicator that don't have this, which I personally like. It just makes it a little simpler. But essentially, when we're seeing these bars, these histogram bars expand, that means the move is gaining strength. It's essentially gaining momentum, because what that means is the short-term moving average is diverging from the longer-term moving average. And we're going to learn a little bit more about moving averages a bit later in the lecture, but just keep that in mind. And again, I'm going to be blowing through this content at a pace where I think is reasonable, but I'm not going to spend all day on everything, right? I want to make sure we get through this kind of basics so we can talk about the more important stuff, which is how these indicators interact with each other and how to really make trades off of these, right? Right now, I just want to lay the groundwork for how to actually understand them, what they mean, and a little bit of background on how they're derived, just so you know what you're looking at, because it doesn't help you to just throw an indicator on a chart and look for the signals, right? You want to know why you're looking for these signals, what they mean, so you have a truly deeper level understanding, because that's what this is all about, right? Anybody can look this stuff up online, but not everybody can tell you why this is the way it is or give you the background knowledge to understand why you should be looking for this. So that's what I'm essentially trying to build. So essentially, we see this cross to the upside here, where the shorter term MACD or MACD line crosses above the brownish line here. We see these green histogram bars essentially indicating the strengthening of a trend, right? Because the short-term moving average is diverging from the longer term one, which means that short-term momentum is increasing. And you can see here how that is related to the price action, right? As these histogram bars stay green, we continue to see that upside momentum. If you notice, they become dark green through a point, and it's very, very hard to notice here, but you can actually see the price action slowing down a little bit at its pace, right? You can see this first move higher is relatively aggressive, right? We move something like 20 bucks in 6 to 7 days. Whereas when the green bars start to turn dark green, we move a little bit less, right? So a little bit less significant, but just to keep that in mind. And you can see here, notice when the moving average or the MACD crosses to the downside, right? So now we have the blue line crossing below this brown line. We see these red histogram bars indicating that we've gotten that cross. We begin to get a move to the downside, right? So important to note how this works both ways, right? It shows us when we're beginning to gain bearish momentum, and it also depicts when we're beginning to gain bullish momentum. One thing that I also want to note is there's also this zero line. And typically this zero line can also help to indicate strength and trend. Typically for a nice bull trend, you want to see the MACD lines above this zero line, which is this pink line here. So when they're both above this pink line, that's essentially another confirmation for bullish strength. And here you can see in this area, it's actually kind of bouncing right around this zero line, which is a little bit interesting, right? So something to keep in mind. Let's see, we got a few questions here. We got FaZe in here. I'll give you some stuff. What time frame do I recommend trading on? Is there maybe a cross on one time frame, but the cross hasn't yet happened on another? Very great question. So what I recommend is when trading, always give more weight to the higher time frames. Again, always give more weight to the higher time frames. We talked about this a lot in the candlesticks lecture and at the lecture last night, so I'm not going to go too far in depth into it, but essentially the higher time frames represent more data. If you think about it, the trading data in a week is much more significant than the trading data from 1 minute or 5 minutes. So you always have to give more weight to the highest time frames. But once you start to see these lower time frames lining up to look similar to the higher time frames, that's something called confluence or time frame continuity. It's when essentially the time frames are giving similar signals all throughout the specific stock. So that's sometimes a signal that you'll be looking for. It's can be harder to find considering there's always something different going on every time frame. So there's a point where, you don't want to be looking at, the weekly, the monthly, the daily, the hourly, the 5-minute chart, the 1-minute chart, the 30-second chart to all line up with the same MACD. That's, probably going to happen once in a blue moon. You're never going to take a trade, right? That's important to keep in mind is you're never going to find the perfect trade. And when you do, it doesn't happen all the time. So we have to take setups that are very close to what we normally take or what we want to take, but something is a little off, right? Trading is more of an art than a science in some ways. I think your strategy should be applied and your rules should be applied as a science, but I think your analysis sometimes requires you to think of it more as an art rather than a science. So that's something that I can expand on a little bit later though. So again, right, this bullish cross to the upside, we get some nice momentum to the upside, whereas we get this bearish cross to the downside, we get a little bit of downside momentum. And again, convergence and divergence indicates the strength of the trend, right? Notice how when the trend first crosses to the downside, we get that gaining momentum and we get a nice move to the downside. Whereas once the price begins to stall in this area, right, notice how it begins to consolidate here, we begin to start converging on these lines, indicating that the trend is now weakening, right? And notice that we get a few fake crosses to the upside and downside here, right? So maybe you went long right at this first bullish cross right here, but you didn't really profit on that long. So it's important to note that this isn't going to work each and every time. And that's not what I'm trying to tell you is this works every time. Every time there's a MACD cross, it price dumps, right? That is absolutely not how any of these indicators work. And it's very important to keep that in mind, right? All this is simply an extra layer of confirmation that says, hey, it's looking like there's going to be a downtrend that forms here. Let's look at some indicators to see what they say, right? So maybe you identify this shooting star potential candlestick pattern here with the bearish engulfing. You see that the MACD has crossed to the downside and you say, okay, that's 2 levels of confirmation saying that we're going to drop here, right? And then maybe you look for a break of support or a lower high to form on the lower time frames, right? Or maybe you look at flow or the moving averages or another indicator, right? So many things to be looking at. Again, this is just one piece of the puzzle. And again, right, just want to notice another example of convergence and divergence here. Notice how quickly this trend down occurred, right? This was a 5-day move and we really dropped about $30, which is massive, massive, massive move. Almost, what was that? 7-8%. So really, really large move, especially for an index like the S&P 500. Notice how we get this big move down. As we get that big move down, our MACD continues to diverge, indicating the trend is strengthening. And then once we begin to consolidate, the histogram begins to taper off. These bars turn a darker color, indicating that the trend is weakening. And then we get this MACD cross to the upside, but we're below the 0 line here. And again, it's important to note that the 0 line can also act as another level to be watching for. And again, when I say 0 line, the reason I call it that is because it's just at y-axis 0. So when the MACD is below the 0 line, you should expect more bearish strength than bullish, right? And conversely, when the MACD is above the 0 line, you should expect more bullish strength rather than bearish. That makes sense. So that's kind of the fundamentals of the MACD. I guess before I continue on to the next indicator, is there any big questions or anything in specific that you guys are wondering? iPhone says pretty much MACD turned red, that's bearish, and green bull. Pretty much, yeah. That's essentially the fundamentals of kind of how this indicator works. But yeah, again, the MACD is essentially built on the difference of 2 moving averages. And yeah, how about if the MACD is above the 0 line but is red? So you can see that occurred right here. So it's still significant. However, you have to keep in mind the context, right? So the MACD is crossing down, but overall trend is still up, right? Now, obviously, we don't see the full chart here. But if we say this is our initial low, ultimately, we set a higher low. And obviously, this was when SPY was in a bull market. So there was multiple lower lows before, I guess, there was a pattern of higher lows at this point in time. So the market was in an uptrend as a whole. So that's just another layer of your analysis is you're getting that MACD cross to the downside, but the market's also in an uptrend. We're seeing strong buying momentum, right? So we don't necessarily have a reason to think there's going to be a long-term downtrend develop. So context is very important as well. And that's something that we discussed a little bit more in the previous lecture and we'll continue to discuss as we develop our analysis on price action. I believe that's towards the end of the month, but does that answer your question? Essentially, it's would be considered a weaker signal. Is the MACD different from using the 9 and 21 EMA? If you use those EMAs to calculate the MACD, it still is a little different because I do believe there is some difference calculation that takes place within the MACD. So they perform a little bit of manipulation on the moving averages. I don't believe it's just the moving averages straight overlaid on here. I do believe it's I think how it works is it's the 26 moving average by default minus the 9 moving average. And then there's the 12 moving average. I believe that's the calculation. I'd have to confirm though. I used to have that memorized, and I guess I don't right now. But yeah, that's just the default settings. Would I recommend using this indicator to project a move to the opposite? The higher, the lower the MACD line falls above or below the zero line, or not so much? Personally, that's not something that I would typically use this indicator for, but that doesn't mean that other people might not use it in that way. Bet that there's a strategy that revolves around that sort of analysis. However, that's not something that I've personally seen in my experience. But like I said, I wouldn't discount the idea of that being something that some people might follow. Kind of thinking about the overextension type of thesis. We will probably touch other indicators, but is the MACD the most useful? In my opinion, it is not the most useful, but in others' opinion, they might completely disagree with me. And again, that's an opinion. It's not the law. So it's really up to you what you find to be the most useful. Me personally, this isn't the indicator that I find to be the most useful though, personally. I personally find moving averages and Bollinger Bands to be more useful. That's those two I use every day in my trading. MACD, not every day. So yeah, but that doesn't mean that it's not useful. Other people use this every day. I know Tilio uses this on most of his charts. I just don't like it as much, but it'd be a disservice for me to not introduce it. So that's MACD. Next, I want to talk about RSI, and the RSI is a little bit simpler. And RSI stands for Relative Strength Index. And essentially, it performs a relatively complex calculation, and it plots this relative strength index line down at the bottom of the chart. First, on a surface level, there's two main levels you want to watch out for on the RSI. There's the 70 level, right, which is denoted by this yellow line right here. And that essentially means a stock is overbought. And when a stock is overbought, it indicates potential overextension to the upside. Conversely, there's also an oversold indicator, right? And I guess I'll note on the chart, right? Notice when this stock became overbought, SPY, we saw a small reversal, right? Next, there's also oversold conditions when the RSI dips below 30. And you'll notice that the RSI makes these little like colored plots so you can kind of see when it's above 70 and below 30. By default, for me on Thinkorswim, when it's above 70, it makes this red kind of plot. And when it's below 30, it makes this blue plot. So on a surface level, when you see the RSI above 70, you should be cautious buying, right? And on a surface level, when you see the RSI below 30, you should be cautious being a seller, right? So essentially, the RSI is indicating to us the strength of a stock, and it's showing us that if a stock is weak or if it's strong based on this indicator. And iPhone, this is a really good question. How about if it's in the middle? So typically, in a bull market, you'll want to see that 50 level act as support. So 50 level is kind of the middle. Typically in a bull market, you'll see that 50 level act as support. So some people consider that price is oversold when it's below 50 when the stock is in a bull market or when the market is in a bull market. And they consider above 50 overbought when it's a bear market. So that's kind of another unsung rule to keep in mind. But some people look for that 50 level as kind of a determination for sentiment. Another thing to keep in mind is just because something is oversold or overbought does not mean it will reverse, right? And these two examples, we saw reversals, but I just want to pull up a quick example here on Tesla, because this is probably one of the best examples. Oh, I can't even spell. So let's take a look at Tesla. I'm just going to clean my chart up real quick, and let's take a look at the RSI. This example is meant to show to you that something that is oversold can get more oversold, and sometimes it will, right? So if you notice here, let me clean this up one more time. Take a look at this, right? Take a look. Tesla's a really great case study for this in recent times. So you'll notice that the RSI has dipped below 30 multiple times. So far, not a single one of these indications has indicated a long-term bottom, right? The RSI has definitely been deceiving here, right? Typically, when you see very strong companies dip below RSI 30, that's typically a very good buy. One company that I like to refer to is typically Walmart, right? Usually when you see Walmart dip below RSI 30, it's usually a very good buy. And in this case, it was, right? The last time Walmart dipped below RSI 30, it rallied, so far, it's rallied 22%, right? So typically, at least in a bull market, I love the idea of buying high quality companies at reasonable valuations and reasonable prices when RSI is below 30, right? That's not the only thing I'm looking at, but it's something I typically keep in mind, right? So blue chip, high quality companies that have histories of strong earnings, right? This isn't some random growth stock. This isn't something, just random that just showed up, right? Long-term companies with histories of growth, strong balance sheets, right? Strong earnings. So that's just kind of another rule that I like to look for. That's not something that I'm currently looking at this point in time. I'm not too much of a stock buyer just yet, but something to keep in mind when we enter the next bull market, which will 100% come at some point. What I want to illustrate here with Tesla, though, is that something that is oversold can and will stay oversold if that's what happens, right? So for example, Tesla first went oversold on this last pullback at 150, and it dropped all the way to 104 as of today, right? So there's been no real significant reversal ever since the RSI has dipped below 30 on this most recent time. And what that can indicate is a sign of weakness. So something that stays in this oversold zone is very, very weak, right? Notice how this RSI 30 level just literally perfectly acted as resistance. This is something that you really don't see every day, but it's crazy to see how this has played out so far, right? Staying oversold no matter any bounce, right? So this is just indicating extreme weakness, right? A really hostile environment for buyers. And this is something that most buyers have just been getting absolutely crushed on. So important to note that something that can get over, something that gets oversold can stay oversold. And just to illustrate the duality of this example, take a look at Tesla during its bull run, right? Something that gets overbought can stay overbought, right? I mean, notice this is back, I think this is 2020, right? Yeah, this is right after COVID, right? So it comes out of this COVID base, breaks higher really, really quickly, becomes overbought, and doesn't have any meaningful pullback after being overbought. And then does the same thing again, right? Becomes overbought and doesn't have a meaningful pullback for weeks after being overbought, right? So important to note that just because something goes over 70 on the RSI means it's a sell. Just because something goes below 30 means it's a buy. This just goes to show that indicators are not always the end all be all, right? At the end of the day, they're just an indicator, right? They can't tell what the price is doing. They can't tell why price is moving. All they can do is run a calculation and plot the level, right? So it's important to note that at the end of the day, the price action is king. And for example, Tesla was running here more for fundamentals than anything else, right? It was running into this 5-to-1 stock split after great news, right? Potentially short squeezing through this time frame as well. So it doesn't matter what the RSI is, right? It's going to run into the split as it did into the next split, right? Next time the split was announced, it ran into that as well, right? I don't know why it's not shown here. That's kind of weird, but oh wait. Huh. Oh wait. I'm confused. Whatever. Regardless, right? Doesn't matter. Just because something's above 70 on the RSI does not mean it will reverse, right? Again, just to illustrate this one more time, a very extreme example. Tesla became overbought on the RSI on the daily here when price was 273. And it stayed overbought all the way through a 53% rally. So if you shorted here and thought you were going to make money on this overbought condition, you were sadly mistaken. So again, very important to note. And this is actually a great question by Martin. How will we know when something will stay oversold and overbought? And unfortunately, there's no way to know and look at the chart and say, this is going to stay overbought or this is going to stay oversold. However, on an example like this, right? And obviously we're looking at the past and it's easy to look back and see what happened, right? If we take a look back at this specific chart, right? Let's look at a few levels here and just notice how price had reacted to them. So let's chart out some previous important levels, which was going to be this pivot here, these previous 52-week highs, right? So let's take a look at this. For example, right? Price had created some kind of consolidation zone above this previous 52-week high and broken it on increased volume. Well, I guess it broke it here on increased volume or tried to, and then continued higher on declining volume. But important to note here, right? This day specifically, the RSI was very clearly overbought. But if you take a look at the price action, this is a really amazing bullish candle, right? You have a bullish candle closing on its high on increased volume with no wicks. That's very clearly a bullish candle. So important to note that here, you couldn't have just looked at the RSI and said, oh, I'm going to short Tesla, right? It didn't work out. And let's say you did short Tesla, right? But if you continue to look at the price action, it is in no way telling you should be short, right? Again, we chart out the previous all-time highs. It breaks that on increased volume again, right? Again, this is another signal to not be short, right? You got an insanely bullish candlestick into these highs and another bullish candlestick above these highs, right? Two candlesticks closing near its high with minimal wicks. That's no indication of bearishness. And obviously, right, I know what happened. So it's easy for me to say, oh, you shouldn't have shorted there. But This is something that you want to be looking for when you see something that's staying overbought and you see the price action that continues to indicate aggression by buyers or sellers. It's important to keep that in mind, right? And same thing here, right? It's the exact opposite. And that's why Tesla is such an amazing example. This is going to be a chart that's going to be in a textbook one day, 100%, if it isn't already in a textbook. However, right, it's the same thing conversely, right? 150 is a really, really critical level of support for Tesla, or at least it was. And we broke through this level incredibly easily, right? We had a bear bar closing near its low right into this 150 level. We had a little bit of a hammer that tried to hold onto this level. And the very next day, we gapped down below it with another bear bar closing near its low. Again, when trading with indicators, you can't just be looking at the indicator and say, yeah, I'm gonna go long because of this, because the chart is in no way giving you a signal to go long, right? Maybe I could find a reason for wanting to long this 150 support, right? Maybe I could see that. But when you see price gap below it and close the next day at its low, if you didn't stop out previously below this low, you should definitely be reconsider being long based on this candle, right? It doesn't take the RSI to look at this candle and say, this is in no indication of any form of strength, right? A bear bar closing near its low, minimal wicks on increased volume, wall oversold. That is no indication of bullishness. And all that is an indication of is continued bearish aggression, which is exactly what you want to see if you're a seller here. Is Charlie in here listening? Poor guy. That's why multiple confluences are needed. 100%, Charlene, 100%. You're so sorry you didn't quite understand the meaning of the 30 level, 50 level, and 70 level for the RSI. I'll just explain them one more time really quickly. So the meaning essentially is just derived from the calculation of the indicator and how it's most commonly used. So I can't necessarily say why the level to watch for is 70, why the level is to watch for is 30. It's just how it is. But essentially this 30 level is typically an indication of oversold conditions. It's when price has gone down too far, too fast. Overbought above 70 is the exact opposite. It's when price has gone too high, too fast. And essentially when you see those overbought or oversold conditions, essentially typical conventional thinking leads most traders to expect a reversal, right? The typical investor isn't going to be buying when price has increased at such a rapid rate. So that's what the RSI is kind of there to help you determine. But again, something that's oversold can stay oversold. Something that's overbought can also stay overbought, right? So keep that in mind. So candlesticks along with indicators can help us to look at puts or calls. Yep, absolutely. Price action is ultimately key. So do I recommend to watch the price action over a few days, hours, depending on the chart? It doesn't necessarily to be any specific time frame, right? These indicators work on all time frames. But if I'm trading strictly based on an oversold condition, I want to be looking for some kind of reversal indication, right? Some kind of candle that indicates to me that there's buyers or there's sellers. For example, maybe like we got some kind of hammer here, right? After this oversold conditions. Maybe you say, okay, look at this little hammer. I'm going to go long, right? So that would be more of a setup that I'd want to long. Maybe even something like this, where we had a bear bar closing near its low, and the very next day we get a really nice bullish pin bar closing near its high above this bearish range, right? Those might be some indications to say, okay, maybe I can long this, right? And obviously in the long term, ultimately, neither of those worked out due to the overall context, right? Clearly in a downtrend. However, those would be more reasonable entries to me rather than trying to go long on a candle like this or this or this or this, right? None of these candles make sense to me to go long, but I could see the argument for somebody wanting to potentially bottom fish, catch the knife, and try and long this candle, but still not a trade that I took and not a trade that I would have taken because I didn't, but yeah. Oh, we got River in here. I already said that. If a bar closes with a hammer, is it bullish even if indicators show bearish? You're talking about AMD. Ultimately, price action is king. I usually disregard any indicator if the price action tells me otherwise, but I wouldn't say that AMD closed with a hammer in recent times. This kind of is similar hammer type action, but not a hammer candlestick that I typically like to see for a reversal. This is more of a hammer style candle. This is going to be a shooting star here, but not exactly at a major top, but more of what I'd like to see for a hammer style reversal. How many candles would I wait for to act as confirmation before making the trade? At least one candle to close and with some form of bullish context. And if I didn't get that, there's times where I'd make a trade maybe at a support or resistance and enter during an open candle, but I'd need that candle to close with some form of bullish context for me to continue to stay in that trade. So it'd be something where you'd have a tight stop, at least one on a higher time frame. Yes and no. So typically on the higher timeframes, that might be something where I'd enter during an open candle. If, for example, maybe something's oversold on the weekly chart, right? Maybe at that point, I would look to grab something at a strong support. And if the candle didn't close with any form of bullish context, I would be forced to stop out, or I'd already have a tight stop loss. So it wouldn't be a problem regardless of what happened. But that would be a little bit more of a high risk trade, considering that you don't have the confirmation. However, you could consider the risk to be relatively decreased, considering ideally you're entering where big money would be entering if you planned your trade effectively. Cool. Your LVS, AMD, I'll look at individual names later if we have any time. If using RSI as a main indicator, where would be the best setup for a call or a put? Typically, if I'm using RSI as an indicator, kind of as a staple, I'd be looking for divergences. And that's something that Charty actually has really a lecture dedicated on in more detail. So it's not something that I'll go on too much detail in, but let's see if I can find a divergence here. That looks nice. Let's see here. Not something that I really like so far on AMD. Let's look at SPY. Amazon Weekly. Oh, it's Frankie. All right, I trust you, Frankie. Let's see. Amazon Weekly. I bet you there is one too. Little tiny one, yeah. Okay, so essentially, I don't have any graphics for divergences because I just leave that lecture to Charty since that's kind of his thing. That's like a big part of his trading style. But if I was trading RSI, typically I'm looking for divergences. So like in this case, it's actually pretty minor. But notice how price makes a lower low here, and the RSI doesn't make a significant lower low, and it actually makes a very slight higher low. That's going to be a divergence, right? And it looks like we also have one here. Yeah, a little bit better one here. So here, price makes equal lows, but the RSI makes higher lows. So that's essentially indicating that there's some strength, right? And you'll notice that there was a nice little rip after we saw that RSI divergence. Now, again, like River says, this isn't something that you shouldn't ever only make trades based off the RSI. You've got to be looking at multiple confluences. Typically, my rule is 5 confluences, at least for a longer term trade is what I'm looking for. A scalp, that's not always possible or necessary. But for the most part, I want to have a lot of reasons to feel confident and comfortable when I'm taking a trade because it gives me confidence. It gives me the reason to hold. But yeah, so hopefully that answers the questions on RSI. The next 2 indicators, I'm just going to briefly run through. I just wanted to show you that they exist just so you can look. Oh, I guess I do have a divergence example. I forgot about this. So here's another example. This one's going to be a little better. Here's a bullish divergence example here. So again, price action makes a lower low. RSI makes a higher low. And again, context was important here. Market was in a downtrend pretty severely, and this was the start of the bear market. So obviously this wasn't going to hold in the long term in hindsight. However, at the time, right, price action made a lower low, RSI made a higher low, indicating some strength, right? So that's what you're looking for in a divergence, essentially. And obviously, they're not always going to play out and send the stock to new all-time highs. We got a little bounce after this divergence was created, but nothing major, but it was tradable. But I can't say that I traded that. I was only day trading on this day. All right. So TTM squeeze, I just want to briefly run through. I don't want to spend too much time on the rest of the oscillators because we got to get to our moving indicators. But TTM squeeze, just want to give a brief introduction here. So essentially not something that I typically use, but some people like it. So it'd be a disservice if I didn't mention it. Essentially what you're looking for is similar to the MACD, right? It has this histogram here, which indicates strength in any specific direction. It's actually the exact same as the MACD here, where you have these blue lines, these light blue lines indicating upward momentum, these dark blue lines indicating downward momentum or decreasing upside momentum, and these dark red bars indicating bullish momentum, and these yellow bars indicating decreasing bullish momentum. So that's kind of the basics, right? Similar to the MACD in that sense. And then you also have these red and green dots in the middle here. And this is something called a squeeze or TTM squeeze. Essentially, these red dots indicate consolidation or a squeeze. And this isn't typically the way I like to identify a squeeze, but some people really do. Essentially, right, what you're looking for when you see this price squeezing is you're looking for once the dots turn green, you want to see which direction the histogram is pointing. So in this case, the squeeze fired, we got this green circle indicating the squeeze is over, and we got this histogram, which is pointing to the upside, and you can see a nice move ensued. Again, just want to give a very brief introduction to this. If you want to learn more about this one, you can look into it. But yeah, I can't go too far in depth because it's crazy how quick this actually goes by. But yeah, that's TTM squeeze. Stochastic slow, a little bit of a combination of the RSI and MACD here. So here you have this red line and this pink line, and you have these 2 blue lines. So these 2 blue lines, I'll start with that since RSI is probably fresh on our mind. There's these two levels on the stochastics, 20 and 80. Essentially, these indicate oversold and overbought conditions, right? So above 80 is going to be overbought, similar to our RSI, except RSI is above 70. And below 20 is our oversold condition here on the Stochs slow. And then similar to the MACD, you can look for crosses to the upside or downside. So again, right, you see this red line cross above the pink line, which is your upside signal. Notice how you get a move to the upside. And if you remember from our MACD example, we also got a MACD cross to the upside right around this candle. So this would be something that you'd be looking for if you're looking at two different indicators, right? You'd see your Stochs slow cross to the upside, then you'd see the MACD cross to the upside. Maybe you identify this higher low in bullish context, right? So that'd be a reason to go long, right? There's three reasons right there. And maybe you didn't long here and you see this nice bullish surprise to the upside on increasing volume, candle closing near its high above this range. Maybe that's your reason to go long, right? So now you have four reasons, right? You got this hammer showing buyers present, range break to the upside, Stochs slow cross to the upside, MACD cross to the upside. There's four reasons to be long right there, right? And I'm sure you could find another one or however many you need for your plan. Yeah, 1K, absolutely. Yeah, Shark, that's something that I picked up off him is always you want to have 3 to 5 reasons why you're bullish on something. And, I didn't realize it at the time, but that is how traders can develop conviction, right? When you have, and multiple reasons to be bullish or bearish on a specific stock, that gives you the reasoning in your head. So, it gives you a reason not to act on emotions because you think back to your logic, your thesis that you spent time developing, and you think to yourself, should I be acting on emotions when I have all these logical reasons to be bearish on something, right? And you have to be very intentional about reminding yourself of those reasons, developing a watch list so you have concrete reasons why you're in a trade, and only cut your trade when your thesis is invalid, right? So if, for example, let's say, I'm not saying this is a good trade, but let's say the only reason you went long on something is a Stochs slow cross to the upside. If it crosses to the downside, what do you guys think you should do, right? If you think, and this is a little bit of a pop quiz, right? So let's say, again, just to reiterate, let's say the only reason I go long on something is the Stochs slow cross to the upside, and I feel bullish because of that, right? That's typically a bullish indication. If the Stochs slow crosses to the downside, what should I do, right? What are your guys' guesses? Should be maybe a little bit obvious, maybe not. What do you guys think, though? My only reason for going long was a Stochs slow crossing to the upside, which is a bullish signal. If I get a bearish cross to the downside, and I kind of just gave it away, right, I should probably be selling, right? So when parts of my thesis become invalid, that's when I reconsider if I'm still belong in a position. But until that happens, I don't sell my trade. As long as my reasoning adds up and it's valid reasoning, it's not something stupid like I read a thread on Reddit, this is going to squeeze, or my neighbor told me to buy this because he likes this lawnmower, right? And he loves John Deere, right? That's not a valid reason to be in a trade. And maybe it is for you. Hey, I can't knock it. I'm sure there's some people that have hit some good trades based on something their neighbor said, right? I've been attached to a trade based on, or somebody caught my eye on a trade, but I did my own research into it when it got mentioned in Trade Floor. So I could see how that could bring you into a trade, but you have to have concrete logical reasoning while you're in a trade, because then you have a clear system when it's time to exit. But I don't want to go too far down that path. This is a Stochs slow. You can look for crosses to the upside and downside. Again, cross to the downside, we get that bearish momentum to the downside. The same thing as the MACD in this case. All right. Cool. And I took that question out just so we can move through a little bit quicker because I want to get into these moving indicators. So first moving indicator, let me stop for a bit. Let me give everybody a quick break. How is everybody doing so far? Are these things all making sense? Am I going too fast, too slow? Are my beginners learning something? Are my advanced traders learning something? How are we doing? Makes sense. Makes sense. You're learning. Okay. Doing great, iPhone. Thank you. Feel like you're learning a lot. Super helpful. Starting to click. Yeah, again, guys, just to keep in mind, I'm not expecting everybody to be experts on indicators after this lecture. What I am expecting, though, is I'm expecting you to take the knowledge that you've learned, either take notes after this lecture, review your trades and see how indicators would have lined up after this lecture, apply indicators in your trading, or begin to study charts with indicators on them that you think that you could use well, that apply well to your strategy, right? So again, that's just how I recommend learning. Everybody's gonna have their own learning style, but important to keep that in mind. Best for beginners to start using. Honestly, I feel like beginners should use significantly less indicators. There should not be many indicators on a chart of a beginner, if any at all. If I was a beginner, though, I would start with moving averages and maybe VWAP, just because I think those are the simplest and give the most information but that's just me personally. Somebody is going to have different opinions. Well, of course, I got my, my club here. Flip says 9 and 21 VWAP, and River says EMA. So I think we're all in agreement there. But yeah, I just think moving averages are the simplest, most effective indicators. I'm probably biased because that's pretty much all I use is moving averages, but that might not be the best for you, right? So there's no one size fits all in trading. There's no one right way to trade either. So what 3 moving averages do I recommend? The moving averages I use the most in my trading right now, I will show you in my study sets in just a little bit. So let's talk about some moving averages and let's explain them really quick. There's a lot of types of moving averages in the market, and you've heard me talk about a few already. So I just want to define them really quick. First, there's something that's called a simple moving average. And this is essentially a simple average, right? It takes the amount of data over the specified period and it divides it by the number of data points, right? So for example, if it's a 20 moving average, it takes the closing price of the last 20 candles, divides it by 20, there's the line that it plots. So for example, at this time, the 20 moving average was at 435. So it took the last 20 candles, divided the total by 20, and that's the average, right? Just a simple average. Next, there's the exponential moving average, and that is an average where more weight is given to recent price action. And that's something that I typically prefer for intraday analysis because more recent price action is typically more relevant in my strategy. So that's why I like the EMAs. It's more reactive, it's a little bit quicker, and that's what I prefer. I typically prefer that faster reacting indicator as much as possible. So I typically stray away from the simple moving averages in my day trading. Does that mean that everybody should do that? Absolutely not. That's just what I do. There's also a few other types of moving averages that I typically don't talk about as much or use, but just to give you guys some kind of background, there's something called the DMA, which sometimes is referred to as a daily moving average, which is just a simple moving average, or there's the DMA as referred to as this displaced moving average. And it's essentially a simple moving average with a shift on it, but it can also be exponential, but it just shifts the location of it. I don't fully understand why people like doing that. It doesn't make sense to me, but I don't use it, but it exists if you want to explore. And there's also the whole moving average, HMA, which is a significantly smooth moving average, and it's supposed to reduce lag. So you can kind of think of it similar to an EMA in a sense, but it doesn't have, or it has much more smoothing and kind of external calculations. So the simple moving average is just simple. It's an easy calculation to explain. All the other calculations aren't something I'm going to give a derivation into just because I don't think it's as relevant. And I don't know the calculation for the whole moving average. I don't think it's relevant. But if you want to learn more about those moving averages, you can look into that on your own time. So again, right, multiple types of moving averages. When you're looking at moving averages, there's a few different ways to play them. And I'm going to explain this more when I show my study sets, but just to keep in mind, right, at a surface level, moving averages are support levels, right? So look for bounces or rejections at these support levels, right? So in a bull market, you'll want to see this uptrending 20 moving average or 50 moving average, and those levels will act as short-term support, right? I don't have all these moving averages shown here, but we can pull up the SPY chart here. Let's take a look at our daily chart. Let's go to something clean so you don't have all my levels, which is still not clean, story of my life. Let's take a look at one of my study sets, which conveniently has my most commonly used moving averages, simple moving averages here. So the 20 moving averages in yellow, the 50 moving averages in orange, and the 200 moving average is in red. Notice how I make the 200 moving average in thick red because it's very important, right? On every time frame, the 200 moving average is very significant. Notice how significant it's been in recent history, right? Notice how price reacts to this 200 moving average. It's not something that doesn't matter, right? But notice how these shorter term moving averages matter a little bit less. They're a little less significant, right? So notice how the 20 doesn't act as significant support here, but the 50 is a little bit more significant, right? You notice a few more bounces and rejections. And that's just because the 50 encapsulates more data. So by definition, it's more significant, right? Typically, when we use more data in the market, things become more significant just because a lot of hedge funds, a lot of quants, a lot of traders are data driven, right? They want to see more significant moves or changes in respect to the data to make their trading decisions. So that's just kind of a little bit of background there. And it also just encapsulates more price action data at its core. So it's going to be more significant, right? This moving average right now, this 200 moving average, this level represents the average price that the S&P has traded at over the past 200 days. So it's safe to assume that this can be considered fair value almost for the last more than half a year. right? It can be considered a great selling point, a great entry point if we're trading above it, right? So different ways to think about the moving averages. And since we already have my study set up, I want to talk about how I analyze and use moving averages. And I use my EMAs in the same way. I'm just going to stick with the moving averages or the simple moving averages since it's probably a little bit easier to understand. Essentially, I use my moving averages similar to a MACD. And you guys might be wondering, well, what the hell does he mean by that? Well, again, just to remind you, this yellow moving average is the 20, which is shorter term. Orange is 50 moving average. Red is 200 moving average. What I look for a strong trend is these moving averages to be stacked in order. So I want my short-term moving average above my medium-term moving average above my longest-term moving average. This indicates to me a strong bull trend. And lo and behold, we were definitely in a strong bull trend all throughout 21. No matter what you look at, whether it's the price action, the moving averages, the fundamentals, right? We were in a strong bull trend. The Fed was pumping money into the markets. Doesn't matter what you look at, right? Every indicator was telling you this bull trend is strong. We get a few dips with the 20 below the 50, but we never get all moving averages stacked to the downside until we get into this area. This is where we begin to get a strong downtrend, right? So notice how the characteristics of these moving averages has changed, right? We're no longer seeing the 20 over the 50 over the 200. Now it's the 20 below the 50, below the 200. And that is something that just currently happened. We just got this 20 moving average crossing below the 50, indicating to me a strong downtrend, right? So to me right now, besides the point that we're sitting in a trading range, I don't personally see a reason to be long. All of the moving averages are stacked to the downside. We're sitting in a range, which by definition, there's not really any direction while we're in a range. Context can be considered to be bearish considering the lower high we set here. But for the most part, right, the moving averages aren't telling us to be bullish right now. Again, sitting in a range as well, that's not really telling us to be bullish or bearish. However, moving averages have now stacked to the downside. While we're on the topic of moving averages, I want to show you some of my day trading setups. Let's take a look at the SPY chart from today. So today, in my opinion, was one of the best days to be a day trader. I know obviously not everybody ended green, and that is completely fine. Not everybody's going to be green every day, but I'm going to recap the price action in a little bit more detail later. But I think today was such a beautiful day, and I just want to recap that with the moving averages I have here. So here I have the 20 moving average in light blue. Also, I have the 20 moving average from the hourly chart overlaid on this chart, right? So if we take a look at the hourly, we would see the 20 moving average at this specific level. So I have them both on this 5-minute chart. And this is how I've been day trading recently. And it's been really fun. So what I'm seeing here initially at the open is we have the 5-minute 20 moving average over the hourly 20 moving average, right? Which is great. That's what you want to see for a bull trend. However, after we break this opening range to the downside, which we can talk a little bit more about this later, but we break this opening range to the downside, right? Great. So that's our first indication that we're seeing some bearish momentum developing. Next, we break our hourly 20 EMA to the downside. That's your next reason to be bearish. Next, the 5-minute 20 EMA crosses below the hourly EMA, indicating more reasons to no longer be bullish. And finally, the 20 EMA from the hourly begins sloping to the downside, further indicating that you need to be bearish, right? And ultimately, we didn't see any form of reversal until we got some kind of constructive base building going on with this double bottom patterning with elevated volume on each side of the lows, right? And that's something that I'll recap in more detail. I just want to give a little bit more background into some of the indicator setups and how I use EMAs, right? So again, right, all I have is 2 moving averages on this chart, the 5-minute 20 EMA and the 20 or the hourly 20 EMA. That's it. 2 moving averages. That's all I've been using recently, and I've been really loving it. How do I do that overlay? It's a custom study that I've been using. I can share it later tonight, or I can share it right now because I'll forget. Let me remember how to show this. Haven't shared something in a while. Let me share this now because I'll forget. Multi-time frame moving average. Okay. Cool. Let me paste that in my tab right now. So I'm going to put that here. Multi-time frame moving average from lecture. Cool. And we'll pin that. Sweet. All right. So, oops. So that's that. How do I get out of this? Okay. So Yeah, that's that. Again, the indicator or the moving averages that I use right now is the 5-minute 20 EMA and the hourly 20 EMA, and I overlay them on the 5-minute chart. And I've been really enjoying it. It works super well with my strategy, and it's been helping me a lot. Actually, it's been helping me remove my bias that I typically come into the day with, and just focus on what these moving averages are doing. That's how I develop my bias. Is every day I look at these moving averages and I say, are they trending up? Are they trending down? Are they stacked to the upside? Are they stacked to the downside? Are we below them? Are we above them? Are we below them? I look at a chart, and in 2 minutes, I already have an idea for what direction the market is trending and where the strength is at. And I already know what direction the probability is in more in my favor. Obviously today, initially at open, it looked like we were in bullish context. However, I mean, if you're trading the first 15 minutes of the day on a new year, you're a different kind of crazy. I personally wasn't. I know Flips was probably hitting trades. I couldn't bring myself to do it. And ultimately waiting helped me, because I maybe would have gone long, considering my strategy would have told me to go long at a move like this intraday. But thankfully I waited, as I think I should have. That's just how I trade. So yeah, that's a little bit of insight into my moving average setups. And that's kind of the main thing that I use right now. Next study I want to talk about is Bollinger Bands. And this is another one of my staples. So typically I have my moving averages always on my computer charts, and I always have my Bollinger Bands on my phone charts. I don't know why, it's just kind of my habit these days. So I like it. So Bollinger Bands essentially represent, okay, I'll take a step back. First and foremost, this middle line is the 20 moving average, just the 20 simple moving average. Now, the red line and the pink line represent 2 standard deviations above and below this midline or this moving average, right? So I want to talk a little bit about standard deviation in just a second. Ultimately, with the Bollinger Bands, you want to use them similar to moving averages. You want to look for bounces at the lower Bollinger Band. You want to look for when the price breaches the lower Bollinger Band. You want to look for expansions and contractions. And the reason I'm going to give you in just a second. So I want to talk a little bit about standard deviation first. Those of you might have been in statistics class in high school and thought, when am I ever going to use this in my real life? This is never going to matter. Well, I'm here to tell you that actually it kind of does apply to what you're currently doing, which is trading. So this is a normal probability plot. This is essentially the representation of what standard deviation looks like in a perfect world. This mu logo, which is this Greek letter here, represents the mean. In this case, it's the 20 moving average, or this blue line is going to be our mean. Then we have 1 standard deviation, which is represented by this sigma, and 2 standard deviation, which is represented by 2 sigma. So what you can see here is about 68% of all data lies within 1 standard deviation of the mean. So we have 1 standard deviation above the mean, 1 standard deviation below the mean. Next, we look at 2 standard deviations, right? So 2 standard deviations above the mean and 2 standard deviations below the mean represents about 95% of all data. Finally, we have 3 standard deviations above and below the mean, which encapsulates about 99.7% of all data. You might be wondering, well, what does this mean and how does it apply to what we're currently talking about? Because right now it sounds like you're just on a tangent. And to be fair, it probably does sound like that. So what does this mean, right? Well, essentially, these Bollinger Bands represent this normal probability plot to an extent. And this is actually something that I wanted to clarify now. River's been reading the book on Bollinger Bands written by the inventor of Bollinger Bands, John Bollinger. And stupid me, I've been leaving out one of the more fundamental laws of statistics, which is sample size. So by definition, a sample size below 30 technically isn't exactly representative of this normal probability plot. This normal probability plot represents a sample size that's large enough for the data set that it's representing. And in this case, 20, which is the default moving average that Bollinger Bands uses, is not greater than 30, which means that the sample size isn't always going to be representative of the normal probability plot. It's safe to assume, however, that the behavior is going to be relatively similar. River read me a statistic out of the book that about, instead of 95% of all data within 2 standard deviations, we should expect about 89 to 91% of all data. So it's slightly decreased considering the sample size is smaller. However, the general principles of standard deviation and statistics in general still hold true. So why does this matter? Well, when price extends outside of these Bollinger Bands, the probability of a reversal begins to become higher. Because if you think about it, based on the rules of statistics, 90 to 95% of all data with this sample size should be within 2 standard deviations. And the Bollinger Bands are calculated on price action closes. So what that means is 90 to 95% of all price action closes should be within these 2 standard deviation lines. And you can see that pretty much, it is about looking like about 85% in this example, maybe 90. But you can see, right? Every time price dips below this Bollinger Band, it usually comes back in relatively quickly, right? And again, similar to RSI, just because something is outside of the Bollinger Bands doesn't mean it's time to buy, right? That's not what I'm trying to say here. However, what I do look for in some cases is I look at the third standard deviation Bollinger Bands. And if you remember, I discussed how the third standard deviation Bollinger Bands should encapsulate 99.7% of all data. Again, due to our sample size, it should be a little bit decreased. So we can assume maybe it's closer to 97, 98%. However, if we look in the past year of data, price on the daily has not closed outside of the third standard deviation bands, which is these red ones, once. It hasn't closed out of them a single time. It has traded outside of them twice, but price quickly reversed back within the bands. So something that I look for is when price extends outside of these bands for a reversal trade, right? If you look at it even on, I think it was SPY a few days ago. Yeah, Reddit Open. Reddit Open, SPY breached these bands. Just because price is outside of these bands doesn't mean to go long. But if you're short or thinking about shorting, you should very significantly reconsider the risk to reward of being in that position when price is so significantly extended outside of these bands. At this point, you have to remember that a very small amount of price action will close outside of these bands. So automatically, the laws of statistics and probability are not in your favor. And that's when you need to become more defensive, right? That is not the time to be aggressive. That is the time to become defensive, to protect your capital or take your profits, and understand that prices move very rapidly in one direction. And ultimately, probability is significantly unfavorable for a continuation in that direction. Now, again, similar to RSI, it can happen, right? Check this out here, right? Notice how this candle closes below the third band and price extended even lower here, right? So you could have potentially been stopped out if you had your stop set below the low of this bear bar, right? And maybe you would have gotten stopped out and missed a small reversal, right? But it's important to note that every time price extends outside of these bands, the probability begins to increase for a reversal. I also will note that similar to the RSI, something that is outside of these bands can stay outside of these bands and will. For example, look at when price broke below the second standard deviation Bollinger Band here on SPY. This to me indicates weakness, right? And I actually wasn't looking at this indicator while I was looking at the moving averages here, but this to me indicates weakness, right? We have a bear bar closing near its low, right on top of a strong support level being the 20 hourly moving average, right? So bear bar closes near its low, right at the opening low. Price breaks below this level, retests above, then breaks below and breaches the second standard deviation Bollinger Band. It closes below and then just rides that all the way down for another $3, right? $2, right? So this band, $3, I was right. So this band can act as support in a strong downtrend as well. So when you see price holding this level or not significantly bouncing out of here, the trend is strong to the downside, right? It's similar to seeing RSI hold below a specific level, right? And yeah, like River said, that also can be the tricky part, is you have to understand, okay, is it going to bounce here or is it showing that it's strong in one direction? And that's why it's important to wait for candle closes, right? This is actually a really great example that River showed me here. This is similar to actually the creator of Bollinger Band, some examples that he likes to trade. Here you can see how price, and credits to River for this example, and I might botch how I explain it just because I just kind of found out that he trades a specific pattern. But obviously this is a pretty clear double bottom, right? I think most people who understand patterns could identify that. Again, not expecting everybody to know that because we haven't had our patterns lecture yet, but very evident double bottom, right? We're seeing expansion of volume at both bottoms, right? Which is something that you want to see for a nice double bottom. Maybe some kind of little wedge formed here before this double bottom as well. So showing selling momentum. Now, if we were looking at our Bollinger Bands, notice how the first time price broke to this double bottom, we broke below the second standard deviation band. And I'll remove the third just so it's a bit cleaner because this is typically what you'll be using. So it broke below this band. But notice the second time we made this bottom, we did not close below this band, right? And that's something that you want to see for an indication of reversal. And we could have probably a whole lecture, or at least River could, considering he's reading the book, on patterns to watch when trading Bollinger Bands, or even Tilio could probably talk about that for a whole lecture. I haven't read the book, but I want to, so I'm gonna. And maybe, in the meantime, River can talk about the in-depth strategies he learns. I don't want to, talk about that in too much detail because I don't have the knowledge myself. I'm just getting it through telephone from River. But yeah, so that's just a little bit of more background on Bollinger Bands, and why I like them so much is I'm a very data-driven trader, and I really look for multiple confluences to be in my favor. And Bollinger Bands are a quantifiable probability of reversal, and that's why I like it. It's just because you can't argue with it. So important to keep that in mind. Do I think it's more important to trade with indicators or trade based on candlesticks and chart patterns? Candlesticks and price action, 100%, always over everything. Price action and volume rules everything else. It doesn't matter what any indicator tells you. If price action says differently, price action is right. Price is always right. Go back to that, whatever. I don't know, what's that one? Whoever that guy that ran that show is. The price is always right. The price is the truth. It doesn't matter what you think, what you're guessing, what your indicator is telling you, what your amazing algo is telling you, whatever. Price is king. Always, it always will be, it always has been, and that will never change. Oh yeah, I guess I didn't expand explain the expanding and contracting. Good point, Kayla. So essentially, when you see the bands begin to expand, that essentially is showing an expansion in volatility, right? Because when you see those standard deviation ranges increase, that means that price is trading in a larger range. So when you're seeing that range or those bands increase, essentially, again, expansion of volatility, and it's also coupled with an expansion in momentum in that specific direction, right? So for example, once you see these bands open up to the upside after price breaks this range, that's a pretty nice signal that's telling you, hey, I'm pretty strong in this direction, right? Again, if you remember, this is the same example where we looked at MACD, Stokes slow, this specific candle right here, right? So just throughout this lecture, we built multiple reasons why this breakout matters. And I want to pull out all these indicators. And again, this is a year ago. This is a long example, but it's an amazing example of confluence. And I just want to go back to it very briefly. So let's pull up our indicators here and let's take a look, right? So we want to take a look at, let's take a look at the MACD and let's take a look at Stokes slow, right? Because those are the ones where we both use this example, Stokes slow. All right, let's take a look at this example, right? So check this out. You're getting a contraction in the bands, right? Notice how they're beginning to squeeze in tighter. You can see it here. And then all of a sudden, price breaks this range higher, right? So first, how I would understand this chart is I would look and see this hammer style reversal candle, not quite a hammer, but a nice pin bar with a nice downside wick in bullish context, right? Setting a higher low in a larger term uptrend, right? Remember, the moving averages are all stacked to the upside here, maybe the 20 will the 50, but for the most part, we're in a well-defined uptrend, right? So we're getting some bullish context that's becoming built here, right? So nice pin bar with a wick at its low. Then let's say you don't long there. You don't actually bottom ticket because that's going to be hard, right? But let's say you're looking at it this day, right? You're looking at this range high, this previous swing high right here where we saw a lot of sellers. We now see a strong break above here, right? Our MACD has crossed to the upside with increasing momentum. Our Stokes slow has crossed to the upside and it's also expanding and it's not overbought or oversold. And let's say you didn't long it there either, right? Let's say, okay, you're like, I still didn't want to long this, right? You didn't believe in it just yet. Then you see another follow through gap up. The MACD expands again. The Bollinger Bands begin expanding, indicating that the momentum is building in whatever direction the price is trending, right? So the Bollinger Bands expanding doesn't indicate direction. However, typically when you see the bands expanding when price is trading above the 20 moving average or the mid band in this example, that's indicating upside momentum is building, right? And same thing to the downside, right? I guarantee we've seen it before. Again, check out this expansion, right? Price is below the 20 moving average. We have a MACD cross to the downside, Stokes slows cross to the downside. Bands are expanding as we trade below the mid band, this blue line. Bands are expanding, indicating that volatility and momentum is increasing to the downside, right? So many more examples of this, right? Again, bands begin expanding to the upside. Price trades above the 20 moving average. We get a nice move to the upside, right? Bands expand. Price is below the 20 moving average. We get a downtrend, right? No expansion in the bands. Here we go. Bands begin expanding. Price breaches the 20 moving average. I mean, I probably sound like a broken record, but every example is working, right? Again, bands begin expanding. Price is trading above the bin band. We get a move higher, right? Every single time, right? I mean, it's like, you can't really make this stuff up. Again, bands expand. Price is above the 20 moving average. Upside move. Again, bands expand. Price, actually, I guess it was below the 20 moving average, or it was a little bit above. So this is probably the first fail, is we were a little bit above and then the expansion started. But regardless, right, it just goes to show how these bands can be so powerful. And again, all indicators are just tools. They're not the law. They're not the rules. However, it can be great confirmation to add on top of a trade. And hopefully this example helped you show a little bit of confluence, right? How we're looking at multiple indicators in conjunction, right? This is the example that I'll finish off on because this is a really nice one. Check this out. So you have a previous swing high here, right? A local high right at this 410 level. Next, you have this candle that gaps into this potential double top level. This was on the, I think, CPI data or something that gapped in, or maybe this was FOMC, I don't remember. But regardless, right, we gapped into this double top level. We're outside of the second standard deviation Bollinger Band. The MACD is crossed to the downside. The Stokes low is not quite what you'd want to see for a nice bearish downtrend. I can't act like this is something that I would want to see for a bearish confirmation, right? So we have first, price opened above the second deviation Bollinger Band. It opened right at the double top level. MACD is crossed to the downside. Next, let's look at some more confluence, right? If we draw a downtrend from all-time highs, just like that, price would be right above it, right? So this could be something that you'd be looking for price to break back below, right? So we know we have bearish context. We know we're at this double top level, but you might be thinking, okay, price is above this downtrend. Either I'm going to try and long for the retest or I'm shorting a break below, right? Because that's a nice fake out. It induced bullish liquidity above. And that's when we get the nicest moves, when we get a fake out above and then that downside move ensues. That was probably a lot. And again, I'm not expecting everybody to understand that last example. That's something that we're going to continue to build upon. But I just want to give you a little bit of a sample of how things are going to continue to develop, more things that we're going to learn in this course series, more ideas that we're going to talk about, more trade plans we're going to talk about. So at this point in time, the class is going to continue to develop into more difficulty. Last thing I want to talk about, I forgot to have VWAP. I was going to wrap up there. VWAP, last thing. Essentially, this is the volume weighted average price. That's what VWAP stands for. It essentially takes into account volume and a moving average. I'm not exactly sure what the period of moving average is. I think it's like 12 or something, maybe 13. And it takes those both into account. So the volume on a specific candle and the current price, and it plots this VWAP line. And this is very similar to a moving average. It acts as a support and resistance line. You can be bullish above VWAP, bearish below. When you see VWAP trending up, it's an indication of an uptrend. VWAP trending down, indication of a downtrend. Kind of the reason VWAP matters is, at least in the past, before computerized trading and stuff like that, brokers used to be able to guarantee fills at VWAP. So this is when you like call them in and say, hey, I want a VWAP fill or whatever. I want to get filled at VWAP. And I don't know if every client could get this, but obviously this is something that big money could get. And they could call in and say, hey, whatever VWAP for today is, I want to get filled there. And whenever price would come back to the VWAP, if it did that day, their broker would execute the order, they'd get filled, and typically the VWAP ended up being a good price for the day. So that's just a little bit of historical context. But yeah, so that's going to VWAP, again, very similar to moving averages in the sense of how it can be analyzed, but the calculation is relatively different. Again, right, bounces, breakouts, rejections, all the same thing as a moving average. I guess I have a question. Oh, okay, yeah, I guess we'll do this one. This is actually a good example since we spent so much time on it. So name this indicator and determine if this action that we're currently seeing is bullish or bearish. This is the last question of the night and the only one that I really kind of had planned out. So name this indicator and tell me if you think this is bullish or bearish and why. What do you guys think here? We talked about this for a little bit. Just throw your example or throw your answers in the chat, okay? We got an answer for Bollinger Bands, okay? Okay, and I'm referring to what's bullish or bearish right here at the most recent price action. What is going on right here? I'll give you guys a little bit of some hints, right? This 20 moving average is our mid band. Remember what we think when we're above and below that, right? Price is above it here, right? We're seeing these bands begin to expand, right? Keep that in mind, right? Keep that in mind. Okay, so we got some people saying bullish, Bollinger Bands. Yep, cool. So let's take a look, right? Again, price broke above the 20 moving average, retested it, and it's acting as support. Also, if you're looking at market structure here, it looks pretty bullish. I mean, we're flagging above this previous bottom formation, right? Maybe if you want to call a little, I'm not even going to say that actually, but the bands are expanding here and boom, look at this uptrend that we got, right? This is just from a few days ago. And look at how nicely this worked out, right? Again, you get that volume back breakout above the 20 moving average. It acts as support. The bands open up to the upside and you get an amazing uptrend, right? And I'm sure we saw a similar move today as well. Might that one bearish candle to cause someone to exit prematurely? Ideally, no. Ideally, you didn't enter after this candle because this entry right here wouldn't represent the highest risk to reward. considering you're entering right at the upper band resistance. And this is just a really big candle to be chasing on, considering there was really low volatility. And then all of a sudden you see this big candle. So Ivy's going to jump on that and you're going to get a pretty bad filling after this candle. So ideally you get a retest, and that's the entry, because that's when Ivy drops. And also obviously your delta is going to give that option contract a little bit better of a value there. So ideally you're not in the trade after that red or before that red candle. If you were though, however, you should not be stopping out based on that red candle alone, right? On decreasing volume while you're still in bullish context with the band or price above the 20 moving average and above this previous range, even if I entered at the tippy top here, which sometimes I do, I wouldn't be selling on this candle. I don't see a reason to sell. I'd probably be sweating a little bit at the bottom of this wick, but if I'm following my plan, I shouldn't be selling when I'm still above the 20 moving average if I'm taking a trade based on the Bollinger Bands. River. Yeah, like I said, I'm not, maybe I would enter at the top. Can't say that I haven't. I definitely have entered at the top before, and it didn't always work out. But if I'm following my plan, there's no reason to sell on this chart ever. You have to wait for candle closes. You can't make decisions on open candles. And the way these candles closed, there's not a single reason to sell after this breakout until maybe if we saw a fake out or if we saw a resistance at this previous base. The next reason I'd be looking to sell is this previous support here or this support here, but we broke every single one of these support levels on rising volume into the close, right? We started that power hour rally a little bit early. So yeah, that's kind of that. Oh, sorry. I didn't update the answer. You guys are right. It's bullish, but I changed the screenshot. It used to be a bearish one. I swear. We're not all dumb. I made the screenshot better. Okay, so we looked into some examples of study sets. So I want to just summarize and wrap up since we're going for pretty long. I can talk about some more setups maybe in the next lecture, but I kind of want to call it at this point. So let's summarize what we discussed. We talked about, well, we didn't talk about setting up studies and indicators. That's another lecture. We talked about oscillators and moving average, and I talked about a few of my favorite indicator setups that I use to make trades each and every day. In the next class, we're going to talk about patterns. I think actually we're going to mainly focus on trends in the next lecture. So trends is going to be mainly what I'm focusing on. Wow, I really should have updated these screenshots. I'm more focused on the content than these slides though. But yeah, these screenshots are super old, but ignore that. This pattern kind of sucks too. But that's funny, right? I was trading at 50. But regardless, we're going to talk about trends and how they're significant. With that being said, we're going to wrap up here for the night. As always, thank you guys all so much for attending. If you have any feedback, comments, or questions following this lecture, please reach out. Send me a DM, message me in TradeFloor, or message our dedicated staff team. We're all here to help and answer your questions as they come up. But it's always a pleasure spending this time here with you each and every week. Again, we know that you guys make the choice to spend your time and your money every night and paying to be in this group. So we always want to make the value that you receive out of these lectures and out of this group as large as possible. So if there's anything we can ever do to make your subscription more valuable for you, please let us know. Please give us feedback. And yeah, always receptive to any ways that I can improve these lectures for everybody. And with that being said, I'm going to call it here. Again, if there's any questions, please just send me a DM. I'm not going to stick around this time around. But yeah, I'm going to call it here. And yeah, hope you guys have a great rest of your evening, and I will see you all in the next one. Adios, everybody.